Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into the latest residential mortgage industry report released by the Canada Mortgage and Housing Corporation, or CMHC. The report reveals that the national mortgage delinquency rate increased to 0.21% in the fourth quarter of 2024, up from 0.17% in the same quarter of 2023.
That's quite a noticeable increase, Steve. It seems like the rising delinquencies in Ontario and British Columbia are significant contributors to this trend. It's a bit concerning, especially as we consider the impact on families and communities.
Absolutely, Janine. As a numbers guy, I'm looking at the data and seeing that this increase aligns with CMHC Chief Economist Mathieu Laberge's forecast from November 2024 regarding mortgage arrears. It's crucial for us to understand these trends to anticipate future market conditions.
And for those of us more focused on the human side, it's important to remember that these numbers represent real people who might be struggling to keep up with their mortgage payments. It's a reminder of how interconnected our financial and emotional well-being can be.
The CMHC is keeping a close eye on this trend, and they're also monitoring other indicators in the residential mortgage market. It's a comprehensive approach to understanding the dynamics at play, which is essential for making informed decisions.
Yes, and it's good to know that CMHC is actively monitoring these changes. It gives us a sense of security that there are experts analyzing the data and providing insights that can help both professionals and homeowners navigate these challenges.
For more details, listeners can download and read the full residential mortgage industry report on the CMHC website. It's a valuable resource for anyone looking to dive deeper into the data and understand the nuances of the current market.
And if you're more of a listener than a reader, CMHC has a podcast discussing the latest report, available on YouTube. It's a great way to absorb the information on the go.
Today, we're discussing the new legislation in Ontario that's aiming to accelerate residential real estate projects. This could be a significant move for the province, and there's a lot to unpack here.
Yes, Steve. The legislation is designed to address some of the inefficiencies in the housing market. By streamlining the development processes and reducing costs, the Ontario government is hoping to encourage faster construction of homes and infrastructure.
That's right, Janine. Michael Surunis, the managing partner and chief investment officer at Hazelview Investments, mentioned that this initiative indicates the province's seriousness in tackling these structural inefficiencies. He sees it as an opportunity for institutional investors to get involved.
It's interesting to see how this might open doors for institutional investors. Surunis highlights that lower construction costs and current low interest rates make it an appealing time for investors, especially those with a long-term outlook.
Exactly. And for developers, this could mean putting shovels in the ground much sooner. It's a constructive situation for builders and developers, allowing them to respond more swiftly to market demands.
And from a community perspective, this acceleration in building could really help with the housing shortage issues many areas are experiencing. More homes mean more opportunities for families to find suitable housing.
The legislation also proposes removing unnecessary barriers in the building environment, which could be a game changer. According to a research note from Osler, Hoskin and Harcourt LLP, changes to development charges and regulation standards are on the table.
It sounds like a thoughtful approach to real estate development. The hope is that this will not only expedite projects, but also attract more diverse investments into the housing sector, which can be beneficial for the entire economy.
Indeed, Janine. Surunis also pointed out that while commercial real estate has been facing challenges, residential real estate remains stable, as everyone needs a place to live regardless of changes in work or shopping habits.
That's a comforting thought, Steve. The stability of residential real estate can provide a sense of security, especially when other sectors might be experiencing volatility.
Let's pivot our discussion to the current state of the condo markets in Toronto and Vancouver, as highlighted in a recent report by the Canada Mortgage and Housing Corporation. It seems these markets are experiencing some weakness, which poses a threat to future housing supply.
That's right, Steve. The report suggests that despite these cities being known for their vibrant real estate markets, the current conditions are causing concern. There are fears that if the situation doesn't improve, it could lead to a shortage of housing in the future.
The numbers indicate that demand for condos has been softer than expected, which has led to an increase in inventory. This oversupply could potentially lead to a slowdown in new construction projects, as developers might be hesitant to start new builds without assurance of demand.
And from a community perspective, this is quite troubling. Fewer new condos could mean limited options for people looking to move into these urban areas, which are often sought after for their amenities and proximity to employment opportunities.
The chief economist at CMHC, Bob Dugan, has pointed out that the market dynamics are shifting due to several factors, including rising interest rates and changing buyer preferences. He noted that potential buyers might be holding off due to economic uncertainties.
It's also important to consider the human element here, Steve. Many people dream of owning a condo in these bustling cities, and the current market conditions could make that dream harder to achieve. It's a reminder of how economic factors can directly impact people's lives.
While the situation is indeed concerning, it's also a period of adjustment. The market often experiences cycles, and this might be a phase where developers and buyers are recalibrating their strategies to align with the new realities.
And let's not forget that the CMHC is monitoring these trends closely. They're providing insights and data that can be incredibly valuable for both real estate professionals and potential home buyers as they navigate these changes.
Now let's shift our focus to the Canadian dollar, which has been holding near an 8-month high against the US dollar. This comes after the US inflation data turned out to be less aggressive than anticipated.
That's interesting, Steve. The Canadian dollar, or the loonie, as we like to call it, has been trading in a relatively stable range. It seems like the inflation data from the US is having a soothing effect on the markets.
Exactly, Janine. The loonie was trading nearly unchanged at 1.3667 per US dollar. It's fascinating to see how the currency market reacts to economic indicators like inflation data. In this case, the expectation that the Federal Reserve might cut interest rates by September seems to be a factor.
Yes, and while the US inflation data is a significant factor, it's also worth noting that Canada's own economic moves, like the increased military spending, don't seem to have had a major impact on the currency's direction yet.
That's right. Carl Shimada, the chief market strategist at Corpay, pointed out that the plan to increase defense spending hasn't materially shifted the loonie's direction. There are still questions about how quickly this spending will translate into economic activity.
And on the home front, we saw that Canadian building permits fell 6.6% in April from March. This kind of data can also play a role in how the currency performs, as it reflects broader economic health.
Oil prices, however, have been a positive influence. They settled 4.9% higher recently, which is significant given that oil is one of Canada's major exports. This increase was partly due to heightened security concerns in the Middle East, which affected global markets.
Indeed, Steve. It's always a complex interplay of factors that influence currency values, and while Canadian bond yields edged lower, reflecting a similar trend in U.S. Treasury yields, the overall picture for the Canadian economy remains mixed.
Absolutely, Janine. It's crucial for investors and homeowners alike to stay informed about these developments, as they can have far-reaching implications for the economy and individual financial decisions. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.